Okay, good morning to everyone and welcome to this session sponsored by the BIS in the LACEA seminar. The session is named The Rise of Central Bank's Digital Currencies. I am Alexandre Tombini. I am the current chief of the BIS in the Americas. I'm based here in Mexico City, as you can see behind me, the Chapultepec Park. So I'm very honored to chair this session with so many friends today. The LACEA kindly agreed to having this special session on central bank digital currency, or the so-called CBDCs. And on behalf of the BIS, I would like to thank them for allowing us to hold this session today. So some of you may not be familiar with what the BIS does, so let me say a few words before I pass the floor to our presenters today. The BIS is a bank for the central banks, and as its name says, but in addition to operate a bank, the BIS also is an important forum for central banks cooperation, where central bank officials share information and discuss important policy issues. Currently, as we all know, one of the hottest areas of cooperation and debate at the BIS is technological innovation and digital money. Technological improvements are bringing about dramatic change on the way people and firms pay for goods and services, among other many things. Latin America and the Caribbean have not been at the forefront of the payment innovation space until recently, relative to other regions. Retail payment services in Latin America were involving high costs and some inefficiencies, as we all know, and this has contributed over the years to limiting the access of population to electronic and digital means of payments. However, I am glad to say that conditions have started to change for the better in the last few years. The region has seen rapid growth of fintech firms offering, for example, payment gateways, aggregators, digital wallets, and mobile points of sale. In addition, as we know, some big techs have already entered the market or attempted to do so. For instance, we have the Mercado Pago, which is a spin-off of Mercado Libres, that allows users to pay for goods on its e-commerce platforms. We also have, for instance, Facebook has launched a payment services associated with WhatsApp in the case of Brazil. These private initiatives, however, do not necessarily guarantee that payments are safe, affordable, and inclusive. Our philosophy at the BIS is that both private and public initiatives are needed. The private sector is in a better position to develop and adapt new technologies to users' needs, but initiatives by the central banks and other public authorities are also needed to ensure adequate levels of safety, coverage, and competition. Central banks and other authorities can impose common standards, promote competition, take the initiative to encourage and coordinate projects among multiple private sector operators, can invest in building part of the entire infrastructure or the entire rail for payment systems, and in some cases directly operate them. In Latin America and the Caribbean, there are currently 3 promising initiatives under the leadership of central banks and other public authorities. The first is the establishment of fast payment systems that are accessible at low or no costs, and these are the examples, for instance, of Pix in Brazil, Cody in Mexico, just to name a few. The second initiative is improving a favorable environment for open banking, and the BIS Americas in our office here in Mexico City is bringing together member central banks of the Americas to study technical solutions for enabling open banking. The third are the developments of central bank digital currencies, which is the topic of today's discussions. So without further ado, let me introduce the speakers that need no introduction, but let me do it anyway. So we have Rafael Auer, my colleague from the BIS. He is a principal economist in the Innovation and Digital Economy unit of the BIS. He has written extensively on digital currencies. He will tell us today about the rise of CBDCs at the global level. Next, we will hear from Viviana Alfonso from the Central Bank of Colombia, Banco de la República, which until very recently was working with us here in the BIS Americas and invest a lot in this area of the digital money, digital payments. So we're glad to see you back, Viviana, even in a virtual form today. So, and she will speak on CBDC developments in our region, in mostly in Latin America and the Caribbean. Finally, last but not least, my friend and Professor Aswad Prasad from Cornell University and former IMF official, which has had a very high profile in this in the discussions of digital money, and has lots of work, including a book on the matter recently published by him. So very glad to have you here, and you accepted to be the discussion of this important session for us at the BIS. So let me give the floor to Rafael for his 15-minute presentation. Rafael, the floor is yours.
Thank you very much, Alexandre, and also to Fabrizio for organizing this. Let me share my screen. So I'm going to be presenting Rise of the Central Bank Digital Currency, Policy Approaches and Technologies. That is joint work with Giulio Connelli and John Frost. And like always, these represent our personal views and not those of the BIS. Let's jump straight into the topic and discuss what is a retail CBDC and how does it differ from existing money. And traditionally, we've known two forms of central bank liabilities, and they're very distinct. If we think about consumer electronic money, it is today only accessible in electronic form via intermediaries, such as a commercial bank. So you have a legal claim on a financial intermediary, and that intermediary in turn has a legal claim on the central bank. So banks typically hold reserves at the central bank, and that makes their balance sheet safer. But of course, such backing is hardly ever full, and there are risks associated with that. And if we think about that concept, it's very different from another claim on the central bank, another form of money, and that is physical cash, which is always a direct legal claim on the central bank. And it's much more robust because the central bank can directly create it. There is no intermediary risks associated with it. So a retail CBDC is the digital equivalent of cash. It would be a direct legal claim on the central bank balance sheet, accessible without any intermediaries. And that sort of distinction between cash, today's electronic money, and how a CBDC would combine that also makes clear sort of the very basic motivations that central banks have in mind when issuing it, which is that for many, actually, that was the founding reason, providing cash, providing a basic, universally accessible and resilient payment means is a core mandate of central banks. But physical cash is less and less usable. Here on the left-hand side panel, we see the share of retail transactions in the number of payment areas and how the share that is made with cash, and it's been trending down for quite some while. Of course, with the COVID pandemic, this has gotten a new dimension as people have become really concerned that cash and banknotes could transmit the virus. And that has led to a situation that we already have in some jurisdictions where you have a substantial number of outlets that do not accept cash. And so this is the fundamental considerations that central banks have in mind. But there also is a broader set of issues that central banks want to tackle when they are thinking about CBDC issuance. Here, I'm presenting a summary of the survey that the CPMI, a BIS-hosted committee, does every year on what central banks have in mind when they think about the goals of issuing a retail CBDC. And we see, if we look at advanced economies first, we see that payments efficiency and payment safety have always dominated. The patterns in emerging and developing markets are pretty similar, with one exception. Financial inclusion is actually the most important goal right now, and it is always featured much higher. So we need to keep in mind, right, when we think about the motivations for CBDC issuance, is that they're universally across the globe to find a digital complement to cash. And in emerging markets, it's in particular also financial inclusion considerations. Central banks are not only thinking about issuance, they're also testing and developing. Here we see the current state of the database that we're building for this paper. We see there are 2 live CBDC in the Bahamas and in the ECCB region. We see there is ample experimentation, either with only wholesale CBDCs, as here Project ABA between the United Arab Emirates and Saudi Arabia. We see retail pilots, the most prominent one probably in China, and we see research and development work on retail CBDC, on wholesale CBDC, and in many jurisdictions on both of these technologies across the world. So in this paper, we've built a database that looks at all projects, and we what we do is we look at all official central bank communication. We do not take any rumors from anywhere. We only look at anything that has been communicated via official central bank channels. We then generate a CBDC project index. It has the value of 0 if there is no announced project. It is 1 for research, 2 for pilot, and 3 for a live CBDC. We do that for retail projects and for wholesale projects. And the overall project score is just the maximum, whether or not retail or wholesale. We then run a cross-country regression analysis of the drivers of interest in retail CBDC, in wholesale CBDC, and in overall any CBDC project. And I'm just going to show you the evolution of this index across the world. So here's just the cumulative score of all jurisdictions, and we see 2 patterns. First, obviously, we see this massive rise of projects as we enter first late 2019, and I think this is a bit associated with the previous announcement of major corporate stablecoin projects. And then, of course, during the COVID pandemic, as cash concerns became more widespread, we see a lot more experimentation. And a second pattern is that if you look at the relative importance of the orange colors and the green colors, so retail versus wholesale, retail has become really dominant here. Across countries, we look at what drives this, and I'm just going to show you one regression table to sort of summarize the gist of our findings. These are multivariate ordered probit regressions on CBDC project indices, so they estimate partial effects. And on the wholesale side, we see that digitized economies, so those that have a lot of cellular subscription per person, think about issuance. We see that those that are financially very developed also think about wholesale CBDC issuance, but other measures such as the informal economy or trade openness seem to have no effect. On the other side, when we look at retail project scores, here the picture is that more countries with a higher share of informal economy as a percentage of GDP actually are thinking much more intensively about CBDC issuance than others. Trade openness, interestingly, is associated with a negative coefficient, so it is more closed countries that are thinking about CBDC issuance. And again, also like it was the case with wholesale projects, it's countries that have a high penetration of ICT technologies, here measured by mobile cellular subscriptions, and countries that are very innovative tend to be those that are thinking about retail CBDCs. In our work, we also think about the sort of different architectures and which we take stock of what kind of CBDC designs are being pursued. Let me just give you a very brief summary as I'm almost out of time. When we think about the operational architecture of a CBDC and how the private and the public sector work together, we could have a variety of models here. We could have what we term the direct CBDC, where the central bank operates the entire payment system, and there are basically no more private sector intermediaries. We could think about models that are very intermediated, so where the central bank really only does wholesale payments and the private sector does all the retail interactions, and that includes not only onboarding KYC, but also really constructing, like maintaining the entire ledgers that are necessary. That would obviously be a payment system that resembles in its operational setup very much today's system. And then we could have novel hybrid models that sort of combine the private sector intermediaries with a backup system by the central bank. We describe these architectures in more detail and really survey central banks, getting in touch with them, asking them what is sort of the direction of the architecture that you're leaning towards. Let me emphasize that all this data that I'm presenting is up to date as of September 30th of this year. Even though the paper is older, every quarter we update it, and it's available on the BIS webpage. You now have a number of quarterly updates, and the most recent one is that of all the central banks that are thinking about CBDC, most have still not made a choice, and of those that have, very few are going for this central bank operated payment system, but most are going for this hybrid or intermediate option that involves an important operational role for the private sector. So let me conclude here. Around the world, CBDC design efforts are intensifying. Issuance has actually been decided in two smaller jurisdictions, and it may be imminent in other jurisdictions. There is a great deal of heterogeneity in approaches and designs across countries. The architecture differs, the infrastructure differs, how people get access to the CBDC differ, and how it is interlinked with domestic and foreign payment services links. But there is a tendency that all, and actually that's not even a strong tendency, that's a uniform statement true for all publicized projects. They will complement physical cash rather than replace it. And they will, and most or many will offer a solution where you have a cash-like legal claim on the central bank, but an important role for the private sector in the operational arrangements, who onboards the clients, who maintains the infrastructure. And of course, we need to think about how, in the light of these results of this survey, about the broader policy debate about how CBDCs will change the payment system when it comes to competition, privacy, and integrity. And here I want to refer you to our this year's BIS Annual Economic Report special chapter on CBDCs and opportunity for the monetary system. I stop here.
Thank you very much, Rafael, for this, for laying the ground for a more regional approach now that we want to hear from Viviana. We'll keep our questions for the end after our discussion takes the floor. So Viviana, I yield the floor to you.
Thank you, Alexandre. Good morning to everyone, and thank you for this opportunity to present to you this paper on central bank digital currencies in the region that I was working with Fabricio Sampoli and Stephen Cumming while I was in the BIS. This is still work in progress, so any comment you have are very well appreciated. Let me share my screen now. Okay, can you see it? Okay, so just as Rafael, before I start, just the usual disclaimer, this does not represent the views from the BIS, the Central Bank of Colombia, or the Americas Enterprise Institute. And during the next couple of minutes, I want to present just the main points of our paper. I will start by presenting the results of a survey that was conducted to central banks in Latin America and the Caribbean to know about their motivation and the state of their work on CBDCs. Then I will move to the potential benefits that we identify that can be very useful for the central banks and economies in Latin America and the Caribbean region. And finally, I will focus on the main challenges that central banks are facing when deciding to issue or not, and when designing a CBDC. So let me start. We conducted this survey to 21 central banks in the region. 13 of them have already answered this survey to the Committee of Payments and Markets Infrastructures, the CPMI. However, we gather information from other 8 central banks. So overall, we have 21 central banks that participated in this survey. The first result I want to highlight is that there is a very high percentage of central banks in the region that are engaged with the CBDC work. So about 85% of central banks are working in a way or in another in this topic. This is quite similar to the results for the whole world. However, a big difference here is that most of central banks in the region are focusing on retail CBDCs instead of wholesale CBDCs. And also an important result is that although most of the central banks are in a research stage, there are others that are actually very advanced in this topic and make Latin America one of the leading regions in the world on CBDCs. There are actually 2 live CBDCs in the region, the Central Bank of the Bahamas and the East Caribbean Central Bank. There is some pilot projects that have been already concluded, as was the case in Ecuador and Uruguay, and others are highly advanced in the research of the CBDCs. Another important result of this survey is about the motivations. Rafael already mentioned the main of them. And importantly for the region, most of central banks that are working on this topic are motivated for including people into the financial system. Also, they are highly motivated to improve the efficiency and safety on domestic payments. And these motivations are very well related to the state of the payment systems in the region. So Latin America is one of the regions where it is most costly to make a payment and where people is less included into the financial and payment system. So this, of course, has a very high correlation to the reasons why central banks are researching on this. It is important also to notice that, as Rafael mentioned, central banks are not intending to replace cash. They just want to offer an alternative to users, to offer them a digital, safe means of payments, to have the advantage of the digital world, but with the safety of the central banks. Also, what was important in the survey was that the quick developments of crypto assets and stable coins are moving the central banks also to be more interested in this. When we conducted the survey, only a few mentioned that we're conducting really a research on this topic. So this is the right-hand panel on the graph. However, after the survey, we have a series of bilateral chats with them, and many central banks were showing that now they are devoted even more and more efforts to understand what the effects of these stable coins are and how CBDCs can help to, let's say, stop the advance of these private assets into the payment systems. Okay, so I was just mentioning that these motivations of central banks for issuing CBDCs are highly aligned with the states of payment systems in the region. So we see in the left-hand panel how costly it is for people in the region to conduct a payment. It's actually the region where it is more costly to make a payment, especially with credit cards. And this is very much a reason why the financial inclusion is so low in the region. It's actually the lowest when you compare with others. So with the pandemic, and Rafael already mentioned this, digital payments get an extra boost. And also this was the case for the research of central banks on the topic. So if you check the left-hand panel, you see that for almost more than 30% of central banks mentioned that they changed their priorities to research on CBDCs due to the pandemic. And the reason is because they want to offer a safe means of payments that complement the cash transactions when social distance is required. This is still happening. There are some services that have not recovered completely after the pandemic, and still cashless and social distancing measures are important. Okay, so let me now move to the potential benefits that we identified for the region. So a first one that I want to highlight, and very closely related to what I was mentioned about the state of payment systems in the region, is that CBDCs could offer a mean, to increase competition in the payments landscape in the region. So as a CBDC that is rooted in a platform that promotes competition and allows different types of institutions to participate into the payment landscape, they can offer a way that financial inclusion increases in the region. So for instance, a central bank digital currency can offer a platform where banks or new fintechs and digital wallets can participate into the central bank platforms. And the central bank offers a neutral means of payment that is the same for everyone. So this will promote competition between the payment services provided, that which in turn reduces the cost for users, which could increase financial inclusion. Another benefit that we have highlighted for the region is that these central bank digital currencies can offer a way in which data of users is protected in a better way than with private developments. So this is especially important in a region where people do not trust financial institutions and big techs, and in general, they don't trust a private sector with their data. So this is another advantage. And finally, the central bank digital currency could help to improve resilience and safety of the payment system by backing up some other private developments that are occurring in the electronic payments. So this is also true for countries in the region that have already fast retail payment systems or have an efficient payment system that is working. So there are some countries in the region, as Alexandra mentioned, that are already at the forefront of innovation, having efficient payment systems, as is the case of BIS in Brazil or CODI in Mexico. So BIS, for example, that has been launched last year, is already dominating the payment systems in the region in Brazil, sorry. But with central bank digital currencies, there are some other advantages for these countries. The first one that I want to mention is this offline payments. If CBDC is designed to offer offline payments, they can be done with a fast retail payment system is not currently the case. So this is important for a region where infrastructure is still a limitation in rural areas, for instance, that have not access to the internet. Another one is that the CBDC reduces let's say, the credit that occurs between payment services providers when there is a deferred settlement of the fast retail payment system. But with the CBDC, the settlement is immediate, so this credit is reduced. And an additional benefit for those countries is that CBDCs offer an improved version for cross-border payments. So they basically reduce what is occurring today in the right-hand panel, where there is a very long change of corresponding bank relationships. With the CBDC, that can be simplified significantly. Then the cost and the speed for this kind of payments can improve very fast and offer to consumers a very convenient way to send money abroad. So let me now move to what have been the choices that in the region the countries have made for their CBDCs. So for the first choice about the architecture, all central banks that have any project or live CBDC in the region have chosen hybrid models. The exception is Ecuador, but this means that central banks are opting for a two-tier system where the central bank is in charge of the main infrastructure, but commercial banks and private institutions are in charge of onboarding and conducting KYC procedures. For the second choice, the central banks in the region have moved more to a centralized infrastructure instead of a DLT. However, in the Bahamas and the East Caribbean, they are using a combination of this. So they have a DLT technology for transaction ledgers and a centralized infrastructure for settlement of payments. Regarding cross-border use, all countries but the East Caribbean by definition are using only CBDCs that can be used at the national level. And many central banks are offering offline payments for users. So the payments can be conducted when the network is down, and then when it's back again, they are updated against the system. So offline payments are available. An important decision also that have been made is about how the transactional and personal data is used and saved. So the central banks are trying to protect privacy of users, splitting the personal data from the transactional data, and central banks can be tracking only the transactional data, but divided from the personal data. So they are anonymous to the central bank, but not for the payment services providers. And finally, well, we have two live CBDCs, the Bahamas and the East Caribbean, and some pilot projects that were already concluding. The case of Uruguay, and Jamaica has just announced its pilot project that is expected to end at the end of this year. And Ecuador had a CBDC that occurred during 4 years. And okay, we are still seeing the new developments and announcements that Brazil has made and other countries in the region that are moving more and more to the central bank digital currencies. So I just want to conclude with 3 main ideas. The first one is that central banks in the region are highly interested in CBDCs. And actually the region is one of the leading in the world in this work. The second one is that CBDCs offer additional benefits for countries that already have efficient payment systems. And finally, that most projects in the region have moved to hybrid models that respect the two-tier system in which the current payment environments occur. So I will stop here.
Thank you so much, Viviana, for this overview of where we are in terms of CBDC in the Americas. So I think it's very informative, and I'm sure my colleagues here will have questions for you after we hear from Professor Svar Prasad. He will discuss both presentations now. So Professor Prasad, I yield the floor to you.
Thank you, Alexander. It's really a privilege to be at this BIS organization. And I know that the BIS and you and your colleagues, Alexander, have been really at the forefront of work on this very important policy issue for central banks and indeed governments around the world. These two papers very nicely complement each other. And of course, many of the authors on these two papers, which were presented by Rafael and Viviana, have been leading a lot of the BIS's analytical and policy work in many of these areas. And they represent a very important stock-taking exercise. The paper that Rafael presented provides a very nice overview of where things stand in terms of the motivations of different central banks to issue CBDCs, the sort of technical infrastructures that they seem to be moving towards. And what I liked about the paper is the fact that, as he said, rather than relying on assumptions or innuendo, what you've done is actually formally look at what central banks have been saying and what they have been doing in order to conduct your analysis, and then try to figure out if, on the basis of economic variables at the country level, you can understand what in fact seem to be the key motivations. And of course, the second paper that looks at Latin America is looking at a region that is intrinsically very interesting. And of course, even in the CBDC arena, has really been at the forefront, although sometimes this tends to get underplayed. As Viviana pointed out, Ecuador and Uruguay undertook some of the early experiments in terms of CBDCs, although in a very limited form. Of course, Ecuador turned out to be something of a failed experiment. Uruguay was a much more successful experiment. And I think there are important lessons to be learned from both of those experiments. And of course, Latin America is also the home to some very odd experiments, such as Ecuador trying to decree that Bitcoin is a legal tender, or for Venezuela to issue an official cryptocurrency, the petro. So it is certainly a very interesting region to look at. Now, as I looked at the empirical work in both papers, which is quite interesting in terms of better understanding the motivations both at a global and regional level, a couple of thoughts did come to mind. One, for instance, is in the paper by Rafael, for instance, which is, and that framework is used in the paper that Viviana presented. There is some discussion about how trade openness might be potentially important. And it turns out that in the regressions, it's not obviously important in the way you might expect for retail CBDC, but a little more so for wholesale CBDC. But of course, my mind immediately went to thinking about whether capital account openness might be another element to look at. Now, as was pointed out by Rafael, most central banks that are considering issuing CBDC seem to be thinking about it as a matter that is relevant for their domestic jurisdictions at large. But certainly there is a concern that having stable coins issued by payment providers that are outside these jurisdictions, or having digital versions of some of the major reserve currencies being available in other regions, including in Latin America, where, of course, dollarization has been a pervasive phenomenon. That could be another potential motivation. So it will be interesting to look at whether de jure capital account openness seems to matter in terms of the motivation, but equally whether the difference between the de jure openness and the de facto openness might be another motivation. Maybe there are countries that want to maintain capital account restrictions, but find that in fact, with the increasing conduits for capital to flow across countries, they are becoming more financially open. And maybe these are the countries that view CBDC as potentially an avenue for gaining better control of the financial flows within their economies. As one thinks about Latin America, other considerations come to mind. Many of the benefits of CBDCs were discussed, but in addition, one can think about the fact that it draws economic activity out of the shadows. Cash is certainly a very important lubricant of the shadow economy. And while it is, of course, very difficult to pin down very precisely estimates of shadow economies, there are indications from a variety of estimates that the extent of informality or the size of the shadow economy relative to official GDP is quite large in Latin American economies. So this might be another motivation for governments to think about getting their central banks to issue CBDC, because even though these central banks view CBDC as a complement for cash, one can very well envision a circumstance in which over time, the availability of digital payments, either provided by the official or the private sector, leads organically to a disappearance of cash, and that would certainly bring economic activity out of the shadows. And as I point out in my book that Alexandre kindly referred to, cash also is useful in terms of fueling corruption. It's not like if cash were to disappear, corruption would disappear, but certainly low-level petty corruption does tend to be fueled by cash. So one might think about countries with weak public governance. Again, if you had benevolent governments who wanted to improve the quality of their public governance, perhaps relying on CBDCs as a way to at least at the margin reduce the effects of corruption. So I think in addition to the many determinants that the authors consider, there are others to think about as well. But as we think about CBDCs, there is a broader question that I think this entire debate brings up, which is, what is the purpose of a CBDC from the point of an economy? What role should the government play in the provision of a safe and reliable medium of exchange? Now, history shows us that central banks, once they were established, were very effective at doing that. But if you do have payment providers that are beginning to emerge from the private sector, what exactly is the market failure that causes a CBDC to come into existence, or that motivates a central bank to issue one? Sweden, of course, is an interesting example to think about. The private sector is doing a perfectly good job of providing low-cost digital payments that everybody has access to. But in the case of Sweden, the financial stability objective, the idea that you shouldn't have the entire payments infrastructure in the hands of the private sector, is certainly a compelling argument. But there are countries where I think there is a more legitimate case to be made in terms of the market failure because the private sector is not doing the job. We've spoken about the Bahamas. I was actually on a panel with the governor of the Central Bank of the Bahamas, and he made this point, which is an important one, that there is a need for efficient and low-cost digital payments in the Bahamas. Financial inclusion is an imperative. But given the size of the Bahamian economy, which has less than 500,000 population, it's just not scalable for a private payment provider to come in and efficiently provide those services within the country. So it's up to the government to do this. And then if you look at other countries that are considering moving forward with CBDC, China, which is already undertaking a CBDC experiment, India, which plans to undertake an experiment later this year, they're approaching this from a very different set of initial conditions. In both countries, digital payments provided by the private sector have become quite pervasive. But in China's case, there was a regulatory void that was filled by two very large payment providers, Alipay and WeChat Pay. And what China is trying to do somewhat reactively is use the ECNY as a way of trying to level the playing field so that you can have more private payment providers build on top of what the central bank provides as a payment infrastructure. India approached it the other way, essentially setting up a public payment infrastructure that now allows for a more level playing field that private payment providers can compete on the basis of. But in both of these countries, one might argue that the user case for a CBDC is far less than in other countries because you have cash already beginning to play a much smaller role and private providers are playing a very big role. So in India, the government already provides a public payment infrastructure. So why do we need a CBDC? In China, you already have the private sector doing a very good job of bringing more people into the digital payment system. So why do you need a CBDC? So I think as we think about the motivations for a CBDC, as Rafael correctly pointed out, once one gets beyond the generalities, in each country, there are some very interesting initial conditions that I think need to be thought about. One other thought that came up as I was reading these two papers, which I found very comprehensive and useful to go through, is to think about it from the user perspective. We have gone over why CBDCs might be motivated through a central banks wanting to maintain control of the payment system, perhaps, or at least have a role in it, maintain the relevance of central bank money at the retail level, maintain monetary sovereignty, and so on. But what is the user imperative, either from the point of view of consumers or businesses? So, Alexandre, maybe I would suggest that the BIS do what the ECB already did in the Eurozone, which is basically to survey consumers and businesses about whether they really want a CBDC, and if the central bank were to consider issuing a CBDC, what would be the main concerns? And there are interesting findings that come out of such surveys. In the ECB survey, for instance, the principal reservation that many Euro area citizens seem to have about the introduction of a CBDC in the Eurozone was that of privacy. And I think surveys of this sort can be very useful, first of all, in trying to better understand things from the user perspective, but also to think about how one might structure, both in terms of the technical design, but also the conceptual design of a CBDC in a way that more adequately meets the user needs, again, both businesses and consumers, and perhaps also addresses their many concerns, because certainly many of these discussions that we are going to have in different countries have to take place not just among us economists or technocrats, but really at a societal level, because there might be some societal implications involved. As Viviana pointed out, there are already ways in which you might think about using technology to address some of these concerns, providing some degree of transactional privacy at least, so you don't completely lose anonymity and confidentiality in financial transactions, even if you're using a digital form of payment. But all things considered, I think these sorts of papers are really useful, not only in giving us a guide to what central banks around the world are doing, but drawing, I think, important lessons, both on the negative and positive side, about how, the late movers in this space might start thinking about it, because I think the reality is that the era of cash is fast drawing to an end, and we are moving to a world of CBDCs. But I think there are many important considerations, and papers of this sort and discussions of this sort, I think, are really useful in terms of moving these policy issues along. So once again, thank you for having me at this section. And Alexandre, back to you.
Well, thank you. Thank you very much, Professor Prasad. I think it was a very instigating presentation by yourself. I see that my colleagues here, the presenters, will like to react to some of the issues you raised. I find it quite interesting, the other motivations, like getting around the jury restrictions with regards to capital flows. I think that's an avenue an interesting avenue to explore, and also the issues of bringing to light the shadow of the informal economy and sort of an instrument to mitigate corruption. So I think this is very, very important. Your issues about the need to survey the users at the end of the day, I think this is quite in the heads of central banks. From the experience we have tracked here in the Americas, I think there is a clear understanding that it needs to have a sort of broad societal survey and consultation, because this, at the end of the day, this is money, sovereign money, in another form and shape. But yes, I think, of course, part of this movement is responding to market failures, inefficiencies in payment, inefficiencies in cross-border payment, and the fact that we have this innovation, the digitalization, many quarters of the economy. It wouldn't be different in the payments arena and other financial services. So yes, you're completely right. I'm afraid that the BIS has not the reach to consult with consumers and firms, but through the central banks, our members, yes, we will have certainly some information in the future. So without further ado, let me give the floor back to our presenters to react to Professor Prasad instigating presentation. Rafael or Viviana, you want to take the floor?
I'm happy to start. If first a question, I've lost all video, but you can still hear me?
Yes, we do, and we see you.
Okay, very nice. So thanks a lot, Eswar, to these comments. They're very insightful. One specific response is, and that's very surprising, I've only showed the result for trade openness here, but we've looked into several dimensions of openness, the financial openness. And actually, when you think about it, the one that we really thought would matter was actually remittances, either sending remittances or receiving remittances. But not even that is related to CBDC projects. And that's there's just no systematic evidence between the intensity with which countries are pursuing these CBDC projects and any measure of openness. That's why I presented this result. It's very striking to me. I do not find it intuitive. And maybe a broader response to sort of, I think, a very important point that Eswar raised, the user perspective, and I might add to that also the incentive of these intermediaries that are there to actually direct traffic, their customers' traffic to the CBDC as opposed to other private payment solutions. And I perfectly agree that the use case is not always obvious, because we have to think back that, for example, in the case of Sweden, the motivations are very much resilience questions, and firms, right, firms don't really care if there is a very small chance of an outage, because that's not really a big factor in their expected profits, but the central bank really cares. But users might not care as much too, right? We know users from all the trends in the payment system. We know that what users foremost value is actually convenience. And so this is a very valid point. I just want to underline it. I think when it comes to inclusion, there is a very strong case, because here it's either a cost or an access issue. So there are people who did not use electronic payments because it was too costly, and the CBDC can solve that. It's a very clear case for the user to adopt it. Or when it's an access problem, we were speaking about projects on islands where there was simply no viable electronic payment option in some regions. If there is going to be one, and because the central bank offers it, it's likely to be adopted. So we need to differentiate, but I think I just want to stress that I agree with the general tendency that we really need to think about what's the user case for a CBDC and what's the business model of the private sector intermediaries that we want to involve. And let me stop here.
Thank you, Rafael. Viviana, would you like to react?
Yes. So thank you as well for your comments regarding the users and businesses. I think it's an extra challenge that central banks in the region have. Some of the most recent reports by the Association of Mobile Services Providers shows that even for people that has access to digital wallets and e-money, they just use them as a cash in, a cash out instrument. So once they have a payment, they just cash it out and use cash. So in the region, even beyond the shadow economies that might exist, users do have a preference for cash, for physical cash. So I think that central banks need to have this into consideration. It's an extra challenge that central banks in the regions can be facing when deciding and considering a CBDC. So definitely that's one of the reasons why central banks are also considering to take out of the shadows this economy that you mentioned. But yeah, they also need to think about this. It's quite important when thinking about users. And some central banks are conducting surveys to businesses, especially small businesses and users, to think about the preference they have for different means of payments. And indeed, beyond the cost, they just think about cash as a very flexible means of payments that, like, they feel that it's real, let's say that way. So I think that central banks need to take this into consideration too.
Thank you so much, Viviana. We have 7 minutes to go to the end of the session, so I want to take advantage of this. Let me open the floor if you have questions to the presenters or to our discussants. So we are a few people here in the screens. If you want to take the floor, you either flag it to me or just open your mic and begin. While you warm up, let me pitch in a question. And this has to do with the infrastructure. I mean, one of the dilemmas is whether to go and work over the existing conventional technology that central banks do have, like the RTGS systems, and build the CBDC over this conventional centralized technology, or go to the decentralized technology, DLT mainly option. So I think you mentioned, Rafael and Viviana, also this issue. One of the issues that I have heard about is that programmability is one main, as you mentioned, I think, Viviana, the offline payments is just an example, but aquaplating, adding smart contracts to this CBDC is a very important feature I think the central banks are looking into. And there is this, I don't know if it's a myth or that DLT is a lot more resilient technology, that DLT is much more convenient to develop this programmability feature of digital money. So perhaps, Rafael, what's your what you're thinking about that, and how can you illuminate us on this?
So two reactions. First, it's not scientifically proven that DLT is more resilient than conventional systems, and we need to keep in mind that also conventional systems, when you use a Microsoft email or a Gmail, they will store your data multiple times across multiple locations, and that is a very safe system. And right, the major big techs have never been hacked. So DLT does something different, right? It's about trust. It's that a record is stored and each node checks the entries and doesn't trust the other nodes. And that has some advantages, but it creates a heavy overload, and it can, for example, very easily be attacked with a denial of service type attack. So it's not that one or the other is superior. It's just that they have different weaknesses and strengths. And I think that's sort of what we specifically need to keep in mind about DLT. But a more general consideration is that a central bank, even if technology is all the hype now, is not a technological organization. And I think what is very important is that a central bank shouldn't be focusing on sort of the type of technologies. It should, because ultimately, right, it's the central bank will not develop a conventional system nor a DLT. It will outsource that. And what it should do is it should specify what the system should achieve, the policy goals, and then it should just wait what the incoming bits are, and whatever the technology, it doesn't really matter, right? It's what the system can achieve. And I think that's the main thing. I see somewhat of a tendency in some jurisdictions to sort of specify, well, we need a DLT-based CBDC. But why? I mean, you don't care about the technology, right? You care about a technological package that can achieve your goals. And I think that's I think the main consideration here.
Thank you, Rafael. Well, the floor is open. I have another question for Viviana, and then one for Professor Prasad. Viviana, what is well? You laid out the motivations in the region for adopting or for studying CBDCs. What about sort of the threat of, as I think as Var was saying, of big techs or stable coins taking over the payment systems in the region as a motivation for central banks studying CBDCs as we speak? What was your conclusion from your study? Is this a real motivation that central banks in the region have to accelerate the study of CBDCs?
Well, what we found was that most of central banks are increasingly interested on the effect that these stable coins and big techs could pose to monetary and financial stability and macroeconomics more generally. So when we first conducted the survey, only a few central banks mentioned that they were making active research on the stable coins and crypto assets landscape. However, in our bilateral chats that we have, after that, we noticed that they were devoting each time more efforts to understand and counteract the rise of these privately issued digital currencies. And similarly, in some of the meetings that we have with the BIS member central banks, several governors assess that central bank digital currencies as a way that central banks have to act and avoid the advance of such private currencies. So it's important to notice that for central banks, while it will take several years to develop and design a proper CBDC, stable coins are already here. So central banks are devoting each time more efforts to understand how these stable coins could have an impact on the payment systems in general.
Thank you, Viviana. So I'll give the final word to Professor Prasad, and I want to pick your brains on. I mean, I know that you, in addition of being a specialist in this digital money space, you also are a very close watcher of what happens in China and India, as you mentioned here. So here we have now the CBDC going into the biggest, largest jurisdictions in Latin America, like Brazil, Mexico, so on. What do you think countries like Brazil, Mexico, and others can learn from the experiences that you mentioned? I mean, China is very well advanced in the pilot, and then India. As you know, here you have CODI and PIX. This is a fast payment system built upon the rails of the central banks. So it's more like closer to UPI, to the Indian example than China. But well, China is the largest jurisdiction that is doing concrete work on CBDC. So what are your advice? What's your advice for central banks in the region in terms of what we can learn from exchanges with China and India as we go forward in this CBDCs development?
And thanks, Alessandro. I think there is a lot for the rest of the world to learn from Latin America, and for Latin America to learn from the rest of the world. And I think in terms of design issues, both conceptual and technical, there are certainly cross-country experiences that are important to bear. But I think the India approach is becoming a very useful template for developing economies in particular to think about, because while there is a real need for financial inclusion, for better digital payment systems that are easily accessible to the masses, I think the fact that you can have network effects kicking in with a vengeance, even in this space where there is supposed to be relatively free entry and exit, suggests that the government can play a very constructive role, not in terms of blocking private sector innovation, but really in terms of providing a foundation for that public sector innovation. But moreover, I think India is also pointing out how crucial it is to maintain control of data. I think the notion of having data aggregators who will be regulated by the government and who can give users what they really need, which is the ability to decide who gets to see their data, who controls the data, and who can use their data. And I think data has real value even for consumers. I think that is a very important considerations that countries in the region should keep in mind, because ultimately, as you pointed out, we are going to need the cooperation not just of governments and businesses and financial institutions, but the common man on the street has to buy into these projects. So I think getting them on board is really going to be crucial.
Thank you so much, Professor Prasad, and thank you all the presenters, Rafael, Viviana, and yourself. I think this was a very insightful session, certainly very important for the region and for the BIS. And let me thank all the participants and the LACEA for allowing us to have this session today. Looking forward to seeing you next year, hopefully in person, in another session sponsored by the BIS in the LACEA meeting. So thank you very much. Stay safe and see you later.
Thank you very much.